there's a piece of software you've never heard of that's managing $21 trillion. That's not a typo. $21 trillion, about 10% of every stock, bond, and asset on planet Earth, all running through one platform. It's called Aladdin. And here's the crazy part. It's not just BlackRock using it. Your pension fund uses it. Major insurance companies use it. Even central banks use it. They're all plugged into the same system, seeing the same risk signals, getting the same alerts. So here's my question. What happens when everyone's using the same playbook? What happens if that system goes down during a crisis? And why is no one regulating the most important piece of financial infrastructure on Earth? I spent the last week digging through Fed reports, regulatory filings, and interviews with people who've actually used this thing. What I found should concern anyone with money in the markets. Let's break it down. 1986. Larry Fink is crushing it at First Boston, running their mortgage-backed securities desk. Then he makes one bad bet on interest rates. Cost to the firm? $100 million. Fink gets fired. But instead of disappearing, he becomes obsessed with one question. Why didn't anyone see it coming? The answer was simple. Wall Street's risk management was garbage. Traders were making billion-dollar decisions based on Excel spreadsheets and gut feeling. There was no way to see how a swing in interest rates would ripple through a complex portfolio in real time. So when Fink starts BlackRock in 1988, he builds the risk system first, before managing a single dollar. The platform gets named Aladdin, Asset, Liability, Debt, and Derivative Investment Network. The pitch? What if you could see every position, every risk, every possible scenario on one screen in real time? Strip away the jargon, and here's what it is. A massive risk calculator combined with a trading platform, compliance monitor, and analytics engine, all talking to each other constantly. Every institution using Aladdin feeds in their entire portfolio. Stocks, bonds, derivatives, real estate, private equity, everything. Aladdin then runs thousands of scenarios simultaneously. What if interest rates jump 2%? What if oil crashes? What if three things happen at once? It's doing this in real time across 200 plus clients, which means it's processing roughly 30,000 investment portfolios. The system doesn't just spot risks, it suggests trades to hedge them. It flags compliance issues before regulators notice. It helps rebalance positions as markets shift. Think of it this way. If the financial system were a city, most institutions were using paper maps. Aladdin gave them GPS, then convinced everyone to use the same GPS. By 2024, Aladdin's managing 21.6 trillion. That's bigger than the entire European banking system. If it were a country, it'd be the third largest economy on Earth. The client list? California's pension fund for teachers and firefighters, Deutsche Bank, the Swiss National Bank, the Bank of Israel, Freddie Mac, insurance giants, hedge funds, competitors. When these institutions adopt Aladdin, they don't use it for one department. They rebuild their entire investment operation around it. It becomes their central nervous system. Revenue from Aladdin hit $1.6 billion in 2024, growing double digits. But that number actually understates its importance. Here's why. Aladdin creates three massive advantages for BlackRock. First, it's a data goldmine. Every trade, every portfolio shift, every risk scenario feeds information back. Not specific positions, those stay private, but the aggregate patterns. BlackRock sees market structure in ways no one else can. Second, it locks clients in. Once you've rebuilt your entire workflow around Aladdin, switching costs are astronomical. You'd have to retrain staff, rebuild systems, recreate years of data. Most never leave. Third, it positions BlackRock as infrastructure, not just a competitor. When Deutsche Bank licenses Aladdin, they're partnering with BlackRock even while competing against BlackRock's funds. For years, Aladdin flew under the radar. Regulators focused on banks and trading venues. Software platforms? Not on anyone's list. But lately, different conversations are starting. What happens when this much of the market uses the same risk models? What happens when thousands of portfolio managers see the same signals and get similar recommendations? The UK's financial regulator started asking these questions publicly, so have academics studying systemic risk. Their concern isn't that Aladdin's broken or malicious, it's that concentration itself creates fragility. And there's a more immediate question. Aladdin runs on roughly 6,000 computers in one data center in Los Angeles. What happens if that goes dark? Cyber attack? Natural disaster? Technical failure? There's no backup at this scale. No alternative that 200 institutions could switch to overnight. One portfolio manager at a LA pension fund put it bluntly when they left Aladdin. The worry wasn't the technology failing, it was everyone thinking the same way. But here's where it gets really interesting. To understand Aladdin's power, you need to see what happened when markets actually broke, and who the government called. That's next. Lehman Brothers collapses, credit markets freeze, Treasury and the Fed are staring at financial Armageddon, and they've got a problem beyond injecting cash. They don't know what anything is worth. Banks are holding trillions in mortgage securities and complex derivatives that stop trading. Without prices, no one knows who's solvent and who's dead. The whole system is frozen by uncertainty. So the government makes a call. Not to Goldman, not to JP Morgan, to BlackRock. Actually, it started earlier. March 28, Bear Stearns implodes. The Fed needs someone to value $30 billion in toxic assets for JP Morgan's emergency takeover. They pick BlackRock, specifically their team running Aladdin. Why? Because they had the only platform that could model complex structured products at scale in real time. And they weren't conflicted. Not a buyer lowballing or a seller dumping. Neutral party with the best tech. That was the audition. When the real crisis hit 6 months later, BlackRock became the government's crisis manager. After Lehman, the Fed creates Maiden Lane LLC for Bear Stearns and AIG's toxic assets. Total, roughly $130 billion of the most complicated illiquid securities on the planet. BlackRock gets the contract, not just to value it, to manage it, decide what to sell, when, how to restructure positions to maximize taxpayer recovery. They run it all through Aladdin. The same platform managing pension funds is now stress testing the Fed's crisis portfolio, modeling mortgage prepayments, calculating liquidation strategies. Think about the information this provided. BlackRock now had complete visibility into the worst corner of the crisis. They saw which securities were worthless versus just illiquid, which banks were desperate sellers. The structure of the entire toxic asset market in ways no one else could. That's intelligence you can't buy. Then November 2008, the Fed announces that it'll buy $1.25 trillion in mortgage securities to stabilize housing finance. Unprecedented, the Fed becoming buyer of last resort for the entire mortgage market. But the Fed doesn't have trading desks or portfolio managers or risk systems, so they hire BlackRock to run the whole thing through Aladdin. BlackRock executes every purchase, manages every position, monitors every risk metric. The Fed provides money, BlackRock provides execution and intelligence. Consider what this means. BlackRock could see real-time supply and demand because they were the dominant buyer. They saw which dealers had inventory. They saw pricing before it hit public data. They could calibrate the Fed's strategy with complete market visibility. And here's the uncomfortable part. BlackRock's asset management division was also trading these same markets for clients. BlackRock maintains strict information barriers, separate teams, compliance protocols, confidentiality. By all accounts, they followed the rules. But the optics? When you're advising the government on intervention and managing private money in the same markets, the potential for advantage is obvious, even if nothing improper happens. March 2020. Pandemic hits, markets crater, credit spreads explode, the Fed restarts the crisis playbook. BlackRock gets hired for 3 emergency facilities: corporate credit, commercial mortgages, combined firepower, over $500 billion. Again, Aladdin becomes the government's operating system. BlackRock decides which bonds to buy, how to structure programs, how to maximize impact. And again, BlackRock's regular business is in these same markets, managing bond ETFs, benefiting from Fed support while executing that support. The conflicts weren't hidden, disclosed, debated in Congress, covered by press. But the government's position was basically, we don't have a better option. No one else can do this at scale. That's probably true, but it reveals something about how the system evolved. When markets break, the government doesn't turn to its own capabilities or dealer consortiums. They turn to one private company running proprietary software. Every crisis creates knowledge that persists after it ends. From 2008, BlackRock learned how distressed assets trade, which structures hold value under stress, how different buyers behave when liquidity vanishes. That knowledge doesn't expire. From 2020, they learned how corporate credit freezes and unfreezes, which sectors break first, which structures are most fragile. This isn't insider trading. It's institutional knowledge for managing unprecedented interventions. But it's knowledge competitors can't replicate because competitors don't run Fed programs. All this feeds back into Aladdin's models. Stress scenarios get sharper, liquidity assumptions get refined, crisis playbooks get updated. When the next crisis hits, and there will be one, institutions on Aladdin have better risk models than anyone off it, because those models trained on actual crisis data from the biggest interventions in history. Here's what keeps some people up at night. The government became dependent on BlackRock's infrastructure. It's not that BlackRock engineered this. They built good tech, executed well in emergencies, earned the trust. But the result? A single point of failure in crisis response. What happens next time if BlackRock has its own problems? Cyber attack on Aladdin? Compliance failure creating conflicts between government and private work? The Fed doesn't have backup, no alternative at this scale. Building it now would take years. You can't replicate 35 years of development quickly. But the dependency goes deeper than crisis response. Right now, hundreds of institutions are making daily decisions through the same system. And that's where things get really concerning. Let me show you why. May 6, 2010. The flash crash. In 36 minutes, the Dow plunges nearly 1,000 points, 9%, then recovers. Accenture briefly hits 1 penny. Could be cyber attack, natural disaster, earthquake, wildfire, grid failure, catastrophic software bug during a crisis. These aren't paranoid scenarios, they're operational risks every large platform faces. If Aladdin goes dark, 200 institutions managing $21 trillion suddenly lose real-time risk visibility, trading capabilities, compliance monitoring. They can't see exposures, can't model scenarios, can't execute hedges. Some have backup procedures, manual processes, alternative systems, but those weren't designed to run global portfolios during market chaos. Speed and scale would be completely different. Most likely outcome? Institutions freeze. Stop trading, pull back, wait for the system to restart. That collective withdrawal becomes a market event itself. BlackRock obviously has disaster recovery, redundancy, backup centers, crisis protocols. The point isn't failure, is likely, it's the consequence grew so large it represents systemic risk. We understand this with banks, that's why we have stress tests, living wills, resolution authority. But we don't have frameworks for tech platforms underpinning market infrastructure. US financial regulation is built around entity types, banks, broker-dealers, asset managers, insurers. Each has a regulator and rulebook, but Aladdin doesn't fit. It's not a bank or dealer, it's software licensed to institutions. The SEC regulates BlackRock as an investment advisor, but that focuses on client asset management, not tech infrastructure. No US regulator can stress test Aladdin, mandate backups, or require interoperability with competitors. No requirement that BlackRock maintain alternatives, or that clients can function without it. Europe's slightly ahead. Their securities regulator started examining critical third-party providers, cloud platforms, data vendors, tech systems for concentration risk. But regulation moves slowly, especially on novel questions. By the time regulators fully grasp the Aladdin problem, dominance will be more entrenched. To be fair, BlackRock pushes back. 3 points. First, Aladdin is configurable. Each client customizes for specific needs, strategies, risk tolerances. Same infrastructure doesn't mean identical decisions. A pension with 30-year horizon uses Aladdin differently than a hedge fund with monthly redemptions. Second, client data is segregated. One institution can't see another's positions or activity. Information barriers prevent coordination, creating herding. Third, Aladdin improves stability by giving institutions better risk management. The alternative isn't diversity. It's institutions using worse tools or none at all. Better risk management across the board makes markets safer, not fragile. Reasonable points. The counterargument, they address coordination risk, but not emergent behavior. You don't need data sharing or coordination to create crowding, just similar responses to similar signals, which happens when using the same analytical framework. Here's the scenario that should worry regulators. The next major crisis, when Aladdin signals maximum risk across all clients simultaneously. You'd see pensions selling equities for cash, insurers reducing credit exposure, asset managers deleveraging, hedge funds cutting risk all at once. Same signals, same timing. Liquidity evaporates, spreads blow out, circuit breakers trip. Policymakers intervene, probably by calling BlackRock to help manage the crisis, compounding the dependency loop. This isn't hypothetical. We've seen versions in 2020, COVID, 2022 UK gilt crisis. The difference? Aladdin's footprint is significantly larger now than previous crises, but here's what really changes the game, what BlackRock's building next. Because Aladdin isn't standing still, it's evolving into something potentially more powerful and embedded than what exists today. And that's the final piece you need to understand. October 2024, BlackRock launches Aladdin Copilot, generative AI integrated directly into the platform, not a chatbot. An AI layer sitting on $21 trillion in portfolio data generating analysis, running scenarios, answering complex questions in natural language. A portfolio manager asks, show me all positions exposed to rising rates in emerging markets. Model a 200 basis point shock. Draft a hedge memo. Copilot processes it, runs analysis across thousands of positions, delivers formatted response in minutes, or a risk officer. Compare our corporate credit exposure to positioning before the last 3 recessions. Copilot pulls historical data, identifies pattern changes, highlights differences. This isn't automating simple tasks. It's AI doing work that previously needed analyst teams, and it's learning from every query across every client. Here's where it gets interesting. Copilot trains on aggregate data from Aladdin's entire ecosystem. Not specific client positions, those stay private, but patterns, correlations, relationships, emerging from $21 trillion in live data. Copilot's models trained on a dataset no other AI can access. It learned from how institutions actually manage risk across every asset class, geography, market cycle, since Aladdin started collecting data. When a client asks Copilot for analysis, they're not just getting computation, they're getting intelligence derived from 200 institutions' collective behavior. Crowdsourced wisdom at scale, delivered through AI. The feedback loop accelerates. More institutions use Copilot, the system learns faster. AI improves, more adopt. Adoption grows, data moat deepens. Competitors can't replicate this. You can't train AI on data you don't have. July 2024, BlackRock announces acquiring Preqin for $3.2 billion. Most coverage focused on price. The real story? What Preqin controls? Preqin is the dominant data provider for private markets. Private equity, VC, real estate infrastructure, private credit. They track 200,000 plus funds, 60,000 plus institutional investors, millions of private transactions. Private markets are historically opaque. No centralized exchange, no real-time pricing, limited transparency. Information's fragmented across fund managers, investors, brokers. Preqin aggregated that fragmented data over 20 years. They became the standard reference for evaluating opportunities, benchmarking performance, conducting diligence. Now that data belongs to BlackRock, being integrated into Aladdin. What this enables? Institutions on Aladdin manage public and private assets on one platform, same risk models, integrated analytics, see how private equity correlates with public market risk, model liquidity across listed and unlisted assets, benchmark private fund performance against comprehensive industry data. No other platform can do this. No one else owns both public market infrastructure, Aladdin, and private market dataset, Preqin. But there's deeper strategy. Private markets are where institutional capital is increasingly flowing. Pensions and insurers allocate more to private equity, credit, infrastructure for different returns, and lower public market correlation. As that shift accelerates, whoever controls private market data has enormous influence over capital allocation, shaping which funds get capital, which deals happen, which sectors attract investment. BlackRock's positioning Aladdin as the operating system for both public and private institutional investing. Not just infrastructure, market architecture. BlackRock announces $40 billion partnership to build data center capacity, surface-level infrastructure investment. AI needs compute. Data centers are in demand. Look closer. High-performance computing specifically designed for financial modeling and AI workloads, not generic cloud. Purpose-built for intensive scenario modeling, risk calculations, machine learning Aladdin requires. BlackRock's vertically integrating. Instead of relying on AWS, Azure, Google Cloud, they're building their own. Gives them control over performance, security, costs. Reduces dependency on third parties who could become competitors or suffer outages. The scale matters. 40 billion suggests BlackRock expects computing demand to grow exponentially. Makes sense if Aladdin shifts from traditional risk calculations to AI-driven analysis, orders of magnitude more compute-intensive. It also signals long-term commitment. You don't spend $40 billion unless you expect to run critical infrastructure for decades. One more piece. March 2024, BlackRock launches Boidal, tokenized money market fund on Ethereum. Not massive yet, a few hundred million, but proof of concept for something larger. BlackRock's thesis, real-world assets, bonds, equities, real estate, private fund shares, will increasingly be digital tokens on blockchain infrastructure. Tokenization allows fractional ownership, 24/7 trading, programmable compliance, instant settlement. If that future materializes, someone provides infrastructure connecting tokenized assets to traditional risk management, portfolio construction, compliance. That's what Aladdin's being built for. Handle traditional securities and tokenized assets seamlessly. Hold tokenized treasuries, traditional corporate bonds, private credit tokens in one portfolio, managed through one interface. This isn't sci-fi. The tech exists. Question is adoption, depending on regulation, market structure, institutional comfort with blockchain. But if tokenization takes off over the next decade, Aladdin's positioned as the bridge between traditional finance and digital assets, extending infrastructure dominance into the next generation of markets. All this raises what policymakers haven't seriously considered. When does a private tech platform become so embedded in market infrastructure it needs regulating like a utility? We regulate clearinghouses, central to trade settlement, payment systems, critical to economic activity, credit rating agencies, judgments influence capital allocation. Aladdin now influence more capital than rating agencies, more central to institutional trading than many clearinghouses, becoming the AI layer processing investment decisions for significant portions of global markets. Yet no regulatory framework treats it as systemically important. No stress tests, no resolution planning, no interoperability requirements, no mandated backups. Closest precedent? Telecommunications regulation from the 90s. When phone networks became essential, regulators required dominant providers to allow competitor interconnection, maintain reliability standards, provide universal access. Should Aladdin share APIs with competing platforms? Should there be standards for data portability so institutions can switch without rebuilding? Minimum requirements for backup infrastructure? Legitimate policy questions. Not being asked because financial tech regulation hasn't caught up to how markets operate. Let me bring this home. BlackRock built a platform processing $21 trillion for 200 plus institutions. That platform became the operating system for institutional risk management. When markets break, governments turn to BlackRock and Aladdin for crisis response. Now it's being augmented with AI trained on proprietary datasets, integrated with comprehensive private market data, extended into tokenized assets. Network effects are powerful, switching costs are massive, information advantages are compounding, regulatory oversight is minimal. This isn't conspiracy or scandal. It's natural evolution of market infrastructure in an era where technology scale creates winner-take-most dynamics. BlackRock built better tools, executed well during crises, earned the trust creating this position. But the concentration is real, and concentration creates fragility. Optimistic. Aladdin makes markets more efficient, gives institutions better risk management, provides stability during crises. The tech works, clients are happy, the system's better with high-quality infrastructure. Pessimistic. We created a single point of failure in global finance, handed enormous information advantages to one company, built a system where herding's baked into infrastructure. Next crisis, the concentration amplifies volatility rather than dampening it. Reality is probably between. Aladdin provides genuine value and improved risk management across the institutional world. But that same concentration creates systemic vulnerabilities regulators haven't addressed. The question isn't whether BlackRock's acting maliciously. By all evidence, they're not. The question is whether a system where 10% of the world's investable assets run through one platform is resilient enough for the inevitable stress tests ahead. And what makes this urgent? This isn't static. The platform's growing, AI integration's deepening, data advantages are compounding. 5 years from now, it'll be even more embedded, harder to unwind, more systemically important. The time to think about infrastructure resilience, regulatory frameworks, systemic dependencies is before the crisis, not after. If you've got a pension, 401k, insurance policy, investment account, there's a decent chance somewhere in that chain Aladdin's involved. Your retirement fund's risk management, your insurance company's investment strategy, the stability of markets your savings depend on. You deserve to know that this much financial infrastructure runs through one system. You deserve regulators asking hard questions about concentration risk, backup systems, what happens when everyone's using the same playbook. Ask your pension fund what risk systems they use. Ask if they've considered concentration risk in financial infrastructure. Ask what happens if their primary systems go offline during a crisis. If you work in finance or policy, push for these conversations. Systemic risk isn't just about bank balance sheets anymore, it's about the technology infrastructure markets depend on. And talk about this. The reason Aladdin operated below the radar for so long is because most people don't know it exists. Concentration risk in market infrastructure should be part of the conversation about financial stability. This isn't about conspiracy theories or clickbait. It's the straightforward reality of how much institutional finance depends on one company's software, and what happens when everyone's using the same app. The smart money already knows about Aladdin, now you do too. What do you think? Drop a comment. Should financial infrastructure like this be regulated differently? What happens in the next crisis when everyone de-risks simultaneously? Is there a way to build resilience without killing innovation? I want to hear your take, especially if you work in finance or have seen Aladdin from the inside.